John, hi, how are you?
I'm doing great, Rebecca. How are you?
Oh, I'm good, thanks. And what's it like over there in Canada? Is it warm, wet? We're absolutely throwing it down here. We've had storms for the last few days. So
Well, yeah, it's starting to turn to fall here, so you're starting to get the leaves change on the trees, which is always really nice.
oh, it's probably a lot sunnier than it is here as well. So I'm just looking
on
out at the
on on
dark.
that I can't. On that I don't know if I can comment. Fall tends to be a bit of a colder season here, but we do get some nice days.
Oh, good. Well, I hope it's better than here. So, anyway, we're going to talk about North America and the economy. So, I mean, let's talk about what the big picture to start with. I mean, how are you doing overall in North America? What's the economy like?
It's a good question. So I think if we think of the last 5 years, there's not really a need for us to go back and replay it in a lot of detail. But obviously, a couple of the big trends that we've seen are that in sort of following the COVID
Mhm.
slowdown and in the middle of sort of some of the lockdowns, we did see inflation spike up across different parts of the country. And obviously, inflation has been high in Canada, in the US, and in different parts of the world as well for a couple of years now. And what we started to see in the last 6 or 7 months is that inflation is coming back down. And one of the big reasons for that is that central banks raised their interest rates as a result of higher inflation. And the same thing occurred in Canada. The Bank of Canada and the US Federal Reserve both raised rates as a result of these higher interest rates, as a result of higher inflation, rather. And as a product of that, you've seen inflation come back down. We've had a few months now where inflation growth has actually been at relatively steady and relatively low levels, which is to say that it's holding a lot closer to target. The targets that central banks are really keen to have it stick at than it was in previous months. And as part of that, central banks have now entered what we call a cutting cycle, which is to say that the interest rates that were now high are sort of slowly being lowered. As of the point of this recording, Canada has lowered its interest rates a couple of times. The US Federal Reserve had a big announcement where they decided to lower it by 50 basis points, which is about half a percentage point. And we expect that within this cutting cycle, you're likely to see interest rates continue to come back down over the foreseeable period and into next year as well. Now, one of the things to keep in mind with this is that part of the reason that interest rates can come back down is because we're seeing sort of a slowing of the economy as a whole. So part of the reason that inflation was a little bit higher was because there was just a lot of demand for goods and services coming kind of out of the pandemic. There were a lot of lockdowns. On top of that, there were some supply chain challenges that we saw in different parts of the country. Sorry, there were some supply chain challenges we saw in different parts of the world. Lots of disruptive events that I'm pretty sure everyone who thinks of the last 3 or 4 years can name a handful of. And as part of that, now that inflation's come back down, part of the reason for that is that demand's a little bit cooler. So what you're seeing overall within the economy is kind of a slow cooling off, right? We in economic terms call it a soft landing. There was a lot of fear that if you raise interest rates really high, that you could see these big recessionary effects. But overall, what we're seeing is an economy that's sort of slowly cooling down. There's some continued demand growth, but the indicators are sort of really starting to slow down. And the hope now is that central banks can manage to stick this soft landing, which is to say that they can lower interest rates without inducing a recession. So the economy can just sort of slow down enough that rates can come down, and then economic growth can kind of continue at a steady pace, which would be quite an accomplishment. And it would mean that we'd avoided a lot of negative impacts. Yeah.
Yeah, I was going to say you have a lot of confidence. I'm not sure I have in governments always, but can we just dissect some of that and break it up a bit? So let's start with the inflation. What kind of impact are those inflationary changes going to have on consumers in Canada and the US?
It's another good question. So, like I mentioned, inflation has been coming back down in both Canada and the US. So, within Canada, the last sort of print, which is to say the last public data on inflation, showed that it was actually currently around the Bank of Canada's target. And oftentimes, when I talk about targets for things like inflation, central banks have what we call these sort of bandwidths of tolerance, which is they want inflation at certain levels within the economy. And what they can do is implement measures like raising or lowering interest rates in order to get inflation to kind of stay at some of those levels. And over the last few data releases, what we've seen is that inflation actually has been holding at sort of these lower levels. And central banks obviously have enough confidence in this that they're starting to lower interest rates as well. And part of the reason that that is good news is quite obviously that lower inflation is better for consumers in general, right? Things cost a little bit less. Obviously, there is still a big difference between the price levels that things were at 2 or 3 years ago and where they're at today. But what we're seeing is a big slowing in the rate of growth for inflation on sort of a month on month and a year on year basis. And because of that, central banks have a bit more confidence. But one of the things to keep in mind with this is that lowering interest rates is not an exact science. One of the sayings in economics is that sometimes it is as much an art as a science. And this is one of those times when that might be the case. And part of the reason for that is that if interest rates come down too fast, then you could see consumers who are really excited about having lower interest rates sort of flood back into the market, and there could be a lot more demand for things. And similar to one of the challenges we had when inflation went up last time, a lot of demand very quickly could actually spur inflation back up. So that's a risk that central banks are trying to manage with the pace at which they lower interest rates. But the flip side of that is I talked about this soft landing scenario we could have. If interest rates remain too high or too restrictive for too long and investment gets held back, then you could also see a version in which the economy does tip into recession. So this is part of that art versus science piece. Ultimately, central banks are taking a look at the data that's in front of them, and they're having to make decisions kind of uh, ultimately central banks are looking at the data that's in front of them, and they're having to make the decisions kind of one meeting at a time, trying to understand whether they should hold rates or lower them, and if they're going to lower them, then by how much at any given point in time, to avoid some of those negative outcomes on each side of the path.
So it's a very difficult balance that they're trying to strike at the moment and to get
Mhm.
right. What's the general feeling in terms of people's consumption? Are they holding on to their money? Do they feel confident enough to spend? What do you expect to see in the consumption patterns?
The reason interest rates were higher in the first place was to help deal with what we call excess demand, which is basically demand in excess of supply. That is in part what was contributing to inflation. There were a lot of factors weighing on supply, but in part, overall, that's kind of what was contributing to the spike in inflation. So, in order for rates and inflation to come back, in order for inflation to come back down, and then for rates to also come back down, demand had to decline from some of the
Yeah.
levels it was at, or you had to see increases in supply. But I talked about this idea of kind of this broader economic slowdown, this sort of soft landing approach. So ultimately, what we're expecting in the next few months is sort of some weakening in overall consumption patterns, and there's a couple reasons for that. One is that consumers often start saving a little bit more money in a slowing economy. There's this idea in economics called like precautionary savings. There's obviously been a lot of headlines about recessions. We're starting to see some data prints come out that show that growth is certainly slowing down in different areas, and consumption growth is one of the indicators where that's the case. And because of that, consumers may start to put a little bit more money away as a precautionary measure in case they feel they're concerned about potentially losing their jobs, or in case they feel they need to save a little bit more money. Maybe they're concerned about different things like
Yeah.
inflation. And so there is some of those shifts are definitely factors that you might be able to anticipate. And that could contribute to this kind of slowing of overall consumption patterns. I mean, in Canada in particular, consumers did indicate that they were reducing their spending as a result of both high interest rates and high inflation. So one of the factors to keep in mind here is that you've sort of got these countervailing factors that we can think of. One is that you do see a decline in inflation and in interest rates, which consumers had indicated was holding them back from wanting to spend more in previous months. But on top of that, you have this sort of slowing of the overall economy, which could potentially shift some patterns into more things like precautionary savings. And another big factor here is that there is often a lot, well, in the Canadian context at least, during the pandemic, there was a lot of what we called excess savings. Folks couldn't necessarily go out and spend at the level that they wanted to. So Canadian households actually still have almost $500 billion in excess savings that are sort of stored away
I'm
within
moving
this.
to Canada.
The US households had a fair bit as well, but a lot of that was actually spent down. And it's part of the reason the US economy has been running a little bit hotter than the Canadian economy in the last few months. But for part of that reason, what you're seeing is that there is that risk that I talked about to inflation, that if interest rates come down a little bit too fast, you could see a lot of those excess savings sort of pull back into the economy. And that could have some inflationary pressures overall. So one of the major questions on the consumption side is, are consumers going to potentially spend down some of these excess savings that they've accrued in the Canadian context? And are consumption rates maybe going to continue at this rate in the US in a host of different sectors?
So do you think there's going to be sectors that are going to get particularly change, like you're going to see change? Some are going to do better, some are going to do worse. What are you envisaging in terms of sectors?
It's a really good question. I think one major trend that I want to tease out here that I think answers your question nicely is when we think about consumption patterns overall, we've seen kind of a big split in recent years where consumers are starting to spend a lot more on services, and you're seeing growth in things like durable and non-durable goods. So for context, durable goods is things like cars and like the auto sector and like equipment and purchasing. Kind of not see the same levels of growth in the same way. Now, there are kind of a couple reasons for that. One of the ones that gets thrown around a lot is people were stuck inside during the pandemic. They may have reevaluated their priorities. You've seen big shifts towards things like eating out in restaurants, and buying concert tickets. I'm not going to say that Taylor Swift tickets are overvalued by any stretch of the imagination, but they're definitely expensive.
I
But they're
think you need to
definitely
talk to my
expensive.
daughters.
um, well, that's part of the reason I'm definitely not saying they're overvalued, but I am saying that they're expensive, and some of that inflation could be contributing to the rise that we're seeing in service sector spending in general. Also, durable goods in many cases. I talked about automotive and sort of equipment. Those tend to be interest rate sensitive sectors, which is to say they're the kind of purchases you might want to take on debt to be able to afford. And in times when interest rates are more expensive, you might choose to delay some of those purchases. And in fact, we've already seen some of those shifts in automotive, right? You've seen sort of a slowing of overall sales sort of month on month, as these interest rates, which were high for a while, sort of slowly took time to have effect within the economy. One of the things about high interest rates is we talk about them having lagging effects. Not sure why that's in quotation marks. We talk about them having lagging effects. And as part of those lagging effects, it just takes a little bit of time for the impacts of high interest rates to kind of be fully felt throughout the economy. So oftentimes they'll get raised, and then you'll sort of slowly start to see slowdowns as various purchasing decisions get made that now have to factor in kind of these higher levels of debt. Um, but another shift that I think we're seeing, and this is a narrative that we hear about a lot when we think about consumption patterns, is this idea of like the dividing or the bifurcating consumer market. This idea that we're trying to explain why we're seeing these record levels for things like airfare purchases and air travel globally, while we're also seeing a shift in like grocery consumption patterns, which is what some of the data has been showing us in both the US and Canada, away from premium brands toward non-premium brands. And I think oftentimes there's an explanation that, higher income folks are coming out and wanting to spend a lot on services, and lower income folks are struggling more with sort of this increase in price levels. Now, one of the realities is that there has been kind of real wage growth, within both Canada and the US. And for context, real wage growth means that wages and incomes have grown faster than the rate of inflation over recent years, right? So the actual purchasing power of consumers, even with this increase in price level, hasn't necessarily eroded, by all that much. When you factor in things like debt servicing costs, it might have had a bit of an impact, particularly in certain categories. But overall, there's questions as to whether or not we're seeing this big split. But there's also some potential justification that what you're seeing is sort of more selective consumers. That you're sort of seeing these shifts within individual markets, and that could potentially explain some of this stuff too. Particularly given the fact that services sectors again have seen a lot of this growth. Another reason for this that I think is kind of important to tease out is that both Canada and the U.S. have been experiencing a lot of population growth in recent months, and services include things like healthcare and
Yeah.
education and transportation. And so, if you have a lot of newcomers to the country, then you do see a lot of demand for some of those services as well.
So one of the things that I keep getting all the time at the moment is emails about what I should be buying for Christmas. And that's already happening. And it's quite depressing because I've only just finished my summer holidays. So what do you think realistically is going to happen over the next few months? Because we're going to the holiday season. Of course, the Americans have their Thanksgiving as well. So there's a lot of purchasing going on related to these celebrations. With what you've just said about sort of some people have got quite a lot of money to spend on services and others are struggling, sort of downgrading to non-branded items rather than spending quite so much, and sort of getting this split in terms of income happening. What do you think is going to happen to retail over the next few months?
It's an interesting question. I think a lot of the factors that face retail are the same ones I've kind of teased on in other parts of the economy.
Mm.
So obviously, like I mentioned, there has been real wage growth. So you are seeing higher wage growth in some cases, kind of outpacing inflation. You're also seeing declining interest rates. Both of those things tend to be a little bit favorable for a consumption outlook, particularly if you're thinking about these more interest rate sensitive sectors. But at that same time, you do have a slowing overall economy. And consumers may be changing some of their purchasing or consumption patterns based on some of those concerns, a desire to sort of save in a precautionary sense, and those other things too. Because retail is the way it's sort of categorized in macroeconomics is a bit of a lagging indicator. We don't get data quite as real time as I think we might want for some of these things. Um, it can be a little bit difficult to get a sense of how things like these rate cuts are changing overall spending patterns. But a lot of the changes that I think I've already talked about are what we typically associate with slowdowns. So you can see you can see shifts in behaviors for things like folks might be choosing to dine more at home versus eating out in restaurants. This sort of shift that we see from sort of premium to non-branded items,
Yeah.
as you call it. And overall, maybe there'll be sort of more of like a selectivity about some purchasing decisions that are made, particularly if folks do have some of these concerns. I mean, one of the other realities is that, and I think I mentioned this, inflation expectations play a big role in this, and so does
Yes.
consumer sentiment. I mean, for a lot of consumers, they remember the fact that price levels were lower for the items they used to buy, 2 or 3 years ago. And even if the level of inflation growth, level of price growth has come back down to more manageable levels, there's still this sort of overall sentiment that we're seeing within different surveys in the economy, which is sort of getting to the heart of the fact that because of the high inflation rates that we're seeing, because of high interest rates that we're seeing, consumers' overall sentiment on the economy is not necessarily all that positive. Now that story can be challenged a little bit by this idea that you have been seeing wage growth kind of outpacing inflation. But part of what could also be contributing to this is that overall consumer sentiment, which obviously has a big factor on the level of consumption that folks choose to
Mm.
undertake, is being driven by the fact that real wage growth hasn't necessarily outpaced inflation in every single category that folks like to purchase. And housing is one of the big ones that stands out
Yes.
here, right? There's been a lot of inflation in home prices in both Canada and the US. And so if you have these kind of big visible changes in prices, then consumers might look around and say like, well, I feel like I'm not necessarily as able to get out for some of the things that I'm looking at upon which I generally measure my sort of overall well-being. And one of the other things that I think is always kind of worth mentioning with retail is that while retail in Canada and the US has had a fairly
Mm.
strong 2024 thus far. Um, it is important to remember that because it excludes services, you're likely to see some sort of shifts within consumption patterns, and part of this could also be influenced by things like population growth, which could potentially be driving increases in consumption and services, and maybe for non-durable goods and durable goods as well as some of those changes for between sectors that are more interest rate sensitive as these start to come back down.
So just looking at that whole wages issue, um, what's the job market like as well over there? Because everybody says to me they can't get staff. All over the world
Mm.
say I cannot get well qualified staff. So are they raising wages because they're just trying to attract better people, or is there what's going on in the job market? Are we just having less skilled people? What's going on?
So I think labor shortages have definitely been a problem in a lot of recent months. We are seeing some data that shows that some of the labor shortages are actually being addressed to a certain point. And part of the reason for that is that, as you mentioned, oftentimes when businesses have trouble hiring, one of the ways that they aim to address that is by sort of raising wages. It's sort of econ logic 101. If you can't find someone to work for you, try raising the wage that that they're
Somebody
paid to
will.
be able to work on this. Yeah, yeah. But I do think that part of what we're seeing overall is that there have been, and this refers back to this again, soft landing, slowing of the overall economy. You have seen slight upticks in the unemployment rate in both Canada and the US. But
Really.
oftentimes that gets thrown around as this big, really scary indicator. And I think one of the best ways to understand this is that ultimately it's kind of a percentage measure. So it's a percentage of the number of people looking for work who say that they can't find it. And in both Canada and the US, you are still seeing job vacancies come online. There's coming on at a slower rate than they were before, but part of the reason for that is that they're not necessarily growing at the same rate as the population. So you have more folks who are coming into the country for both Canada and the U.S. who are looking for work, and the rate at which jobs are being created isn't necessarily that high. When that happens, the unemployment rate tends to slightly tick up. But again, there are all sorts of factors there for things like consumption that can make for some stats that aren't always completely aligned with some of what we're seeing as well. So overall, I think in the job market, you're seeing these kind of slight upticks in the unemployment rate. You're seeing these decreases in job vacancies, but all that's kind of to be expected in this broader sort of slowing market. And we're definitely not in recession territory from any of the data that's been printed thus far. And because interest rates are coming back down, the hope is that we can sort of achieve this sort of broader soft landing in this case. And it may be that that unemployment rate actually starts to go down as a lot of newcomers, particularly ones who are, skilled economic immigrants or who have work permits, are able to sort of find new jobs jobs, and can sort of take advantage of it. But it's definitely something worth paying attention to. I mean, in the US, it was a big job. It was a jobs report that triggered some of that August market economic activity. So it's very clear that folks are paying a lot of it's very clear that folks are paying a lot of attention to this indicator, and they're trying to understand sort of what's happening overall. But from what we're seeing, it's kind of standard align with this soft landing scenario, and there's not really anything to be really concerned about at this point.
So do you think it's very much the young people that are being affected in terms of wages um, and unemployment, and the sort of older people are, and I don't mean sort of the pensioner age group, I mean sort of older people, perhaps like myself, who are sort of working are of an older type, so we're perhaps not working as virtually as some of the youngsters are. Do you think that they're seeing different trends between, we're seeing different trends between the two groups?
We definitely are seeing different trends between the two groups. And for youth in this case, I'll kind of focus on anyone who sits in that sort of like, I think the UN
So what
technically
is youth?
qualifies
Can you
youth.
define youth? Because I'm hoping that I can still get in there.
I mean, look, the UN technically defines youth as anyone under the age of 35, which is
Oh no,
something which is
just
something that I
slightly
do state
over
a lot.
there.
However, a lot of other data categories are a little bit lower in some of the age caps that they have. But yeah, we are definitely seeing some differences. I mean, one of the major kind of ways to interpret this is you can think about the fact that on average, older workers tend to be higher earners, right? They're at a different point in their lives. They may be sort of at the peak of some of their lifetime earning cycles. And so in the US and in Canada, in the US and in Canada, a lot of consumption growth that we've seen in recent years had been driven by these sort of highest income earners. So actually, the top 20% of earners have been responsible for nearly 40% of overall consumption growth, right? We know that higher income earners are on average, they're a little bit older. They tend to own more assets as well. So things like house appreciation has contributed more to their wealth than it might for someone who is young, can't necessarily afford a home. And one of the factors that we sort of see here, one of the data points that pops out is that younger households are actually decreasing some of their mortgage debt. But the reason for that is largely because young people are buying less homes than they used to.
Yeah.
And surveys show there's still a big desire to buy a home. That desire hasn't necessarily decreased. So it's likely that affordability is kind of playing a role here and having a bit of a factor. So as such, a lot of these households tend to have less debt than they used to have, but it also may be that redirected cash is getting saved to potentially save up for a house that they kind of still want to buy, or it could be that it's getting sort of spent and consumed in other areas. I mean, for a lot of lower income households, you've actually seen savings sort of declines. They've been having to spend down some of these savings in recent years. So it could be that some of those inflationary and interest rate pressures have sort of had some more effects. But the other side of it is not just the consumption side. It refers back to this job market piece that you mentioned as well, which is that influxes of immigration, part of what we're seeing in the data, particularly in Canada, are having an impact on youth unemployment levels because a lot of lower skilled economic immigrants are coming into the country and filling roles that could have otherwise been filled by youth. And in part, there's this big influx of temporary foreign workers. You know, some of them are young workers themselves. Some of them are students, and they're filling some of these roles that could have like otherwise been occupied by young people. So as part of that, you're sort of seeing young people on multiple ends of the spectrum who might be feeling some of these economic effects and some of the pressures of the last few years in different ways than folks who might be a little bit older and might be a little bit better off.
Yes, I'm very aware of this with my girls and sort of watching them trying to get jobs and worrying about that at the moment. So yeah, it's a very, very real thing. But I want you to look into the future because I can tell
Mhm.
you're a bit of a crystal ball gazer, and tell me tell me what you think is going to come along in the next year or couple of years. What do you think is going to happen? Impossible
Well,
question,
look,
I know, but come on, let's hear hear your best
I
guess.
mean, I think I can talk maybe about some of the known unknowns on the horizon, and I can say if was a crystal ball gazer, I would make a lot more money in sports betting. Um, I d- But I do think like there are some factors that we know are going to have an impact that we're just not completely sure exactly how it's going to roll out. One of the big ones, and this is one of the first ones, is how quickly interest rates come down in some of these different markets, as well as in some other markets that we see globally. If the US Federal Reserve decides to lower rates at a quicker pace than folks expect or at a slower pace, all of that is going to have a big impact on the outlook. And depending on the rate that they pick, it could even impact Canada's overall approach. Canada doesn't tend to like to get too far out of lockstep with the United States when it comes to these things. We are, a market that's about 1/10 of the size. A
Yeah.
lot of our exports tend to be bound for the US. And so we like to be sort of generally aligned on a monetary policy sense within an overall range. So that's a big factor that could really have an impact on the outlook. But there's also like one of the other ones, and this is something I mentioned a little bit. Population growth is another factor that could have a big impact, but here it's about more than just whether or not the numbers are expected to increase. I mean, the composition of population growth matters a lot. I think I've talked about this idea that the kinds of economic immigrants that come into the country, or the kinds of folks who come into the country. In the US, there's a big push for in the US, there's been a lot of growth in folks who have work permits, who are on like refugee or asylum claimants. And in Canada, there's been a big push for a lot of temporary workers, folks who are here either as students or temporary foreign workers. Generally, temporary workers spend less per capita than other immigrants who have achieved things like permanent residency status. And governments have also been implementing policies with an aim of lowering some of the immigration levels. And it kind of remains to be seen how big of an impact some of those pieces will have. I mean, I've already talked a little bit about some of the ways in which population growth has an impact. So it's trying to understand and think through some of the implications for things like job markets or consumption levels on the whole. And then the final big known unknown is elections. The US obviously has a large upcoming presidential election. Canada is actually set to have a federal election at some point in the next year. We're a parliamentary system like the UK, so it can be a little bit
Yes.
tougher to
Yeah.
predict exactly when you have a minority government. But the winners of any election are going to implement policies that impact the economy. That's sort of the way that these big sets of federal elections go. And we know that there are different kinds of measures that could have different types of effects. And in the US, our team has done some analysis looking at the economic impacts associated with some of the major policies that have been put forward by the two parties. And we've identified some potential inflationary impacts associated with what the Republican candidate, some of the actions the Republican candidate has proposed. Now, it obviously remains to be seen who wins and kind of what the victor ultimately chooses to do in this case.
Which of course
But
can be very
if
different from what they say in their campaigns.
Of course. But assuming that some of the policies that folks are advocating for get put forward, there will be implications. I mean, if there are a lot of tariffs implemented that have inflationary impacts, then you could see a resurgence of inflation, which could mean central banks in turn need to raise interest rates again. And that's going to have big impacts on a whole host of different markets. So we, like anyone else, are waiting to see how all that shakes out.
Yes, it's it's a bit of an unstable world at the moment, isn't it, for lots of reasons. So who knows what's going to happen? Perhaps we should get together with you again in another year and see what's happened and how it's all gone down. So maybe we should do that. It would be good to see you again. But thank you so much, John, for today. This has been so interesting, really fantastic to talk to you. If people want to get hold of you, what's the best place to go? LinkedIn or your website?
Yeah, my contact information is on our website at scotiabank.com.
No, that's brilliant. Well, thank you so much, and I'm sure everybody will really appreciate what you said today and enjoy it as much as I have. So, thank you.
Thanks for this, Rebecca. I really enjoyed being here.